Tom Lydon, editor of ETF Trends, here in Boston at the Charles Schwab Impact Conference. I'm here with Bob Deutsche, who is Managing Director of JP Morgan Asset Management. Bob, great seeing you.
Good to see you. Good to be here.
Congratulations on your 1-year anniversary of your first ETF. That's fantastic.
Thank you.
So tell us a little bit about it, because you've got a unique, again, JP Morgan strategy on that global asset allocation program.
Yeah. Well, we really looked at what's available to investors through traditional indices and decided to provide them with an alternative. So if you think about traditional indices, they have a place in portfolios, but they also have flaws. So they represent the market well, they're highly liquid, but they buy overvalued securities, and they have risk concentrations that build at certain times in the market. So we really built an index to compensate for some of those flaws in traditional indices.
And we've seen the international markets struggle in the last year for sure. So it's not like you can buy all and just hold them. You really have to pick your spots. And I think JP Morgan's been at this for decades. We're able to, as advisors and individual investors, get your good management in kind of a smart beta format within this offering. Is that right?
Yeah, exactly. It's a strategic beta, smart beta, whatever you want to call it. But I think importantly for investors to understand the process and the outcome of the process. So, rather than simply buy securities blindly and weight them by size, we first look at sectors of the economy and weight those equally based on risk. We also look at regions around the world, Europe and Asia, and again, weight equally by risk. Then we fill those sectors and those regions with stocks based on a 4-factor model, based on factors that are proven and provide good stock selection. So importantly, the outcome of this is a better risk-adjusted return and less volatility for the investor.
So after 2009, advisors that shifted from active management to ETFs, who were long stocks and long bonds, they were rewarded for that. But are those trends going to continue? And I think we're seeing globally that there might be a little bit more friction out there where you really do need to have more strict strategy.
Well, look, our active management business is doing very well, our active mutual fund business. So we're number 2 in flows year to date in our active equity business. 80% of our mutual fund AUM is in the top 2 quartiles Morningstar for the last 5 years. That's been a tough comparative period, that 5 years. So this for us is a complement to that. I do think well-defined, disciplined strategies make a lot of sense for the right investor, and these complement active funds, they complement traditional indices.
Absolutely. So, the idea here is, I think, for the average advisor who has been patting themselves on the back for saying, hey, I'm long indexes, great, but I think we're going to get back to that situation. We're going to have to pick our spots. And JP Morgan has a great tradition of being able to do that.
And international hasn't been as easy as some of maybe the US indices. So for the 1-year period that we just had, the basic international developed market equity index was about flat. It was actually down a couple basis points. We were positive 251 basis points. And the path of that is this index and our ETF tracked the market index as the market rose through and peaked in May and captured most of that upside, but saw a lot less of the downside as the market blew off in late summer.
And that's a great example. I know you're committed to the ETF space. What are we going to see from JP Morgan in 2016?
Yeah, well, you're going to see a lot more from us. So we're bringing on new people, we're launching new products, and we'll be continuing to build out this suite of equity products, but also moving into other asset classes.
Great. Bob, thanks for spending time with us.
Yeah, absolutely. Thank you.
Thank you.